Welcome to this session of Physical Academic tutorial on cash budget. In this lecture, I will examine the meaning of cash budget. I will give the format for solving cash budget. I will examine those items that will need not to be included in cash budget, even if they are given in the exam questions. What is cash budget? A cash budget is a budget that shows the planned cash inflows and outflows during the budgeted period. A budget that shows the planned cash inflows and outflows during the budgeted period. Cash budget will only contain the item of cash receipts and payment during the budgeted period. The non-cash items are excluded from the cash budget. Even if they are given in the questions, you will not need to include them. You have to remove them or their impact from the item to use in cash budget preparation. So items to be excluded from the cash budget. Items to be excluded from the cash budget. So I've told you those items that does not involve the flows of cash, I said they will not be recorded in the cash budget. Items such as the bad debts written off. Even where it is given, where bad debts written off is given or is included in item of expenses that we need to go into cash budget, you have to remove them. So it will not be recorded in the cash budget. Allowances for trade receivables. This will not be recorded in the cash budget. Number 3, trade discount. Trade discount will not be recorded in the cash budget. Quantity discount will not be recorded in the cash budget. Then depreciation, because it does not involve the flows of cash. Loss from disposal of non-current assets. It will not be recorded in the cash budget. Then profit from disposal of non-cash items. All these items will not be recorded in the cash budget. Dividend proposed is different from dividend paid. Proposed dividend may not result in an outflow of cash, but dividend paid will result in an outflow of cash. So dividend proposed will not be recorded in the cash budget. Then transfer to reserves. All these items will not go into cash budget. Bonus EU. So where you see any of the items listed on the board, so you should exclude them from the cash budget. Format of cash budget. So you write the title. Let me say XYZ Limited cash budget for the month of January, February, and March 20XX. So you state the periods covered by the budget, total, March, February, January. So you start with the items of receipts. You start with the receipts items. Receipts. So receipts may include receipts from customers, the amount received, then proceeds from sale of non-current assets. Proceeds. Let's assume it is sold in the month of March. The total will be in the total column. Issue of shares. So let's assume the shares were issued in February. Then loans received. Loans received. If the loan is received in January, you include it in the month of January. Interest received. Let's assume the interest was received in February. Then rental income. The amount received, let's assume it is received on a monthly basis. Then you can have investment income. The amount received on a monthly basis. Then you sum up all the receipts items in order to get the total receipts. This is total receipts. Let me have the total receipts as A. After the receipts, you have payments items. Payments. So you may have payments to suppliers, payments to suppliers, payments to suppliers, dividend paid, dividend paid is different from dividend proposed, interest paid on loans, rent paid, commission paid, if you have commission received, you have that under receipts. Then wages and salaries paid, wages and salaries paid. Then you may have other payments. If there are other payments I did not list, I did not include in the list of payments, so you include them. You now sum up the payments in order to get the total payments. Total payments. Let me have that as B. After the total payments, then the next item is net cash flows. Net cash flows. The net cash flows will be A minus B. Remember, your A is your receipts item, total receipts. Total receipts minus total payments will give us the net cash flows. It could be an inflows or an outflows. That is, it could be plus, positive, or negative, depending on the question. Then after this, you have the opening balance. Your opening balance may be given. Opening balance. That is opening cash balance. Where it is given, you put it. But if it is not given, then you assume it to be nil. So where it is not given, that means you take it to be nil. So opening balance, if you add the opening cash balance, then you get the closing cash balance. This is opening cash balance. Then the closing balance in January becomes the opening balance in February. If you add it to your net cash flows, you get the closing balance in the February. The closing balance in February becomes the opening balance in March. And if you add it to your net cash flows, you get the closing balance in March. Whatever you have as the opening balance in January will still be the opening balance under the total column. So the sum of everything will give you this. So this is the format for solving cash budget. Now let's take question as work example from ATS 3 cost accounting, March 2025. Keep watching. ATS 3 March 2025 cost accounting question number 4. Batam Limited presented the following monthly sales estimates. We have month, we have sales. Amount is in 1,000 Ghana cedis. January 1 million, February 1.2 million, March 1.4 million, April 800,000, May 600,000, June 800,000, July 1 million, August 800,000, September 600,000, October 1 million. A. Of the sales, 80% is estimated to be on credit and 20% for cash. 75% of the credit sales are collected in 1 month and the balance in 2 months. There are no bad debts. Note B. Purchases amount to 80% of sales are paid for in the month preceding the sales. Note C. Wages and salaries are estimated to be payable as follows. April 90,000 Ghana cedis, May 80,000 Ghana cedis, June 100,000 Ghana cedis, July 100,000 Ghana cedis, August 90,000 Ghana cedis, and September 90,000 Ghana cedis. D. The firm took a loan of 1.2 million Ghana cedis in January with interest at 10% per annum. Interest to be paid quarterly in January, April, and so on. Note E. The firm is to make payment of tax of 50,000 Ghana cedis in July. Note F. The firm has a cash balance of 200,000 Ghana cedis on 1st of April. Required. Prepare a cash budget for 6 months beginning from the month of April. Solution. The name of the entity is Batam Limited. Batam Limited. You have to prepare the cash budget for 6 months. Cash budget for 6 months ending. Since you have to begin from April. Now let's count from April. Where will you have 6 months? April, May, June, July, August, September. 6 months ending September, 30. And what is the year in the question? The year is not specified. So let's rule the columns. 1, 2, 3, 4, 5, 6. I will have included total to make it 7, but there is no enough space, and I wish to capture it well. So now, start beginning from April, May, June, July, August, and September. One, two, three, 4, 5, 6. An amount, the amount is in 1,000 Ghana cedis. Thousand Ghana cedis. Thousand Ghana cedis. 1,000 Ghana cedis. So you start with the receipts. Now, back to the question. On the basis of the information provided, cash will be received from customers in respect of the sales made in the period. One thing I want you to bear in mind is that transactions are entered into the cash budget on the basis of their time lag. What did I mean by that? When in the very month in which the receipts of cash take place. So you record transaction in the cash budget the very month the cash is received or paid. I repeat, transactions are recorded into the cash budget when cash are received or paid. Sales made in the period. So we have sales from the month of January to October. So we have October, we have September, we have August, we have July, we have June, we have May, then we have April, then we have March, then we have February and January. Amount is in 1,000 Ghana cedis. Ghana cedis. So Ghana cedis. Let me put it. The transaction is in Ghana cedis. So in order to economize space and to save time, that is why I don't want to add Ghana cedis here, because the space will not contain that if I add it. We have sales. In the month of January, we have 1 million. February, 1.2 million. March, we have 1.4 million. Then April, 800,000. And May, 600,000. The June, we have 800,000. July, we have 1 million. August, we have 800,000. September, we have 600,000. And October, we have 1 million. Now, you were told in note A that of the sales, 80% is estimated to be on credit and 20% for cash. Now, let's deal with credit sales and cash sales first. You were told of the sales, 80% is estimated to be on credit and 20% for cash. So cash sales, 20%. Credit sales, that is 80%. Now, let's estimate that. So, 20% of 1 million, that will be 200,000. That is cash sales. 80% of 1 million, that will be 800,000. That is credit sales. Then 20% of 1.2 million, that is 240. That is cash sales. And the credit sales will be 80% of 1.2 million. That gives us 960. That is the credit sales. Then 1.4 million. 20% of 1.4 million. That is cash sales, which is 280. The credit sales is 80% of 1.4 million. That gives us 1120. Then we have April. 20% of 800, that will be 160. That is cash sales. The credit sales will be 80% of 800, that will be 640. That is the credit sales in the month of April. In the month of May, 20% of 600, that will be 120. Then 80% of 600, that gives us 480. That is credit sales. 20% of 800, that will be 160. While 80% of 800, that is 640. 20% of 1 million, that is 200. While 80% of that gives us 800. 20% of 800, that will be 160. While 80% of that gives us 640. Then 20% of 600, that gives us 120. And 80% of 600 gives us 480. Then 20% of 1,000 gives us 200. And 80% of 1,000 gives us 800. We've analyzed our sales into cash sales and credit sales. And one thing I want you to bear in mind is that cash sales will be received immediately. So that means the cash sales will be received the very month in which the sales are made. So we have cash sales. Let me have this as working one. This is working number one. The cash sales. Now, our budget starts from the month of April. In the month of April, the cash sales amounted to 160. We have 160. Then we have 120 in May. Then 160 in June. And in the month of July, we have 200. August, we have 160. And September, we have 120. These are the cash sales of the sales made in each of the months. I've told you that the cash sales will be received in the very month in which the sales are made. But now we want to deal with the credit sales. If you look at the information about that, you were told that of the sales, 80% is estimated to be on credit, and that has been calculated. And 20% for cash, this has equally been calculated. Of course, we've included the cash sales in our cash budget. Then 75% of the credit sales are collected in 1 month. 75% of the credit sales are collected in 1 month. What does that mean? Of the sales made in January, 75% of it will be collected in February. Of the sales made in February, 75% will be collected in March. It means we assume that the sales were made towards the month end. The sales were made at the end of each of the months. That is the assumptions. If sales were made at the end of each of the months, then of March sales, then if 75% of its credit sales, that is the sales in the March, those ones that are credit, 75% will be collected in 1 month. That means that will be collected in the month of April in that order. Now, and the balance in 2 months, there are no bad debts. Of course, if there are bad debts does not involve the flows of cash. Bad debts will not be recorded in our cash budget. But now we were told 75% are collected 1 month, while the balance 2 months. Now let's analyze that. 75%, which is collected in 1 month, while 25% is collectible in 2 months' time. So now, the credit sales in the month of January is 800. 75% of the January sales will be collected in the month of February. That is why I put dash in January. That will be collected in February. What is 75% of 800? That gives us 600. So that gives us 600. That is, of this 800, 75% will be collected. You know, the sales were made in the month of January. 75% of that will be collected in February. Then the February sales is 960, which are on credit. The credit sales in the month of February is 960. Therefore, of that, 720, that is 75% of that gives us 720. That will be collected in the month of March. Then of April's sales, of March sales, credit sales is 1120. 75% of March sales will be collected in April, and that amounted to 840. Of April sales, credit sales is 640. 75% of 640, that gives us 480. That will be collected in the month of May, 480. Of May sales, the credit sales is 480. 75% of that 480 gives us 360. That will be collected in the month of June. Of June sales, credit sales is 640. And of that 640, 75% is 480. That will be collected in July. Of July sales, the credit sales is 800. 75% of 800 gives us 600, and that will be collected in August. Then of August sales, credit sales is 640. 75% of that 640 gives us 480, and that will be collected in September. And of September sales, the credit sales is 480. Then 75% of 480 gives us 360, and that will be collected in October. Then of October sales, the credit sales is 800. 75% of that will be collected in November. So now we want to deal with the 25%. Remember, 25% is collectible in 2 months' time. The sales made in January is 800. What is 25% of 800? That gives us 200. That will be collected in 2 months. We won't count January. So if it will be collected in 2 months, that means, by January, February, it will be 1 month. Then the 2 months now will be March, and that amounted to 200. Then, if you count it now, after 2 months, 2 months time, then of the sales made in January, 25% which will be collected in 2 months will be collected in the month of March. And of the sales made in February, credit sales is 960. 25% of that 960 gives us 240. And that will be collected in the month of April. 2 months. No, it happens in February, 2 months now. March, April. Of the sales made in March, the credit sales is 1120. 1120. What is 25% of that? It gives us 280. Now, count 2 months after the month of March, we have April, then May. That gives us 280. Then, of the sales made in the month of April, the credit sales is 640. What is 25% of that credit sales? It gives us 160. That will be collected in June. Of the sales made in the month of May, the credit sales is 480. 480. What is 25% of that credit sales? 120. Now, since it was made in May, 2 months, June, July, which is 120. Then of the sales made in June, the 25% of the credit sales, the credit sales is 640. The 25% of that 640 gives us 160. And that will be collected in the month of August. And of the sales made in the month of July, the credit sales is 800. What is 25% of 800? That gives us 200. And that will be collected in September. And of the sales made in August, the credit sales is 640. 25% of the credit sales is 160. And that will be collected in October. But if you look at our budget period spans from the month of April to September. So let me just sum up those ones that relates to our budget period. April, May, June, July, August, September. Any period outside our budget period, let me just ignore those ones. They are not relevant to our solution. Now, 840 plus 240, that is totaled 1080. Then 480 plus 280, that is totaled 760. 360 plus 160, 520. 0, 10, 5, 6, 600. This is 760. This is 680. Now, we can receipt from customers, receipt from customers. It is still part of working one. So we have 1080, 760, 520, then 600, 760, and 680. Apart from sales, let's go through the other notes in order to ascertain if there are other items of receipts in the question. In note B, note B relates to purchases which were made in the period, and purchases will list is a payment. Payments will be made for purchase. Note C is wages and salaries. That is an expenses that will equally be paid. In note D, the firm took a loan of 1.2 million Ghana cedis in January with interest at 10% per annum. Interest is to be paid quarterly in January, April, and so on. This loan was taken in the month of January. Remember, our budget period starts from the month of April. Since the loan was taken in the month of January, the receipt of the loans would have been made in the month of January. So if January had been part of our budgeted period, it would have been included in the month of January as a receipt. But since January is not part of our budgeted period, that means the receipt of that loans will not need to be included in our cash budget. Now, note E, the firm is to make payment of tax. That is also a payment. And note F is the cash balance. So this shows that the only item of receipt we have in the questions are those receipts made in respect of the sales that were made in the period. Let's sum up the items of receipts. So we have total receipts. Let's have that as A. 160 plus 1080, that is total 1,240. Then 088. 086. This is total 800. This is 029. And this is 008. Now, after the items of receipts, we have payments. Payments, items. You were told purchases amount to 80% of sales and are paid for in the month preceding the sales. Preceding means before. That is the meaning of precede. Before the month. That means the purchases, you calculate 80% of sales, and that 80% of sales will be paid in the month that comes before the month of sales. That is to show that 80% of sales made in the month of February will be paid in January. That is not the month after. There is difference between precede and after. If it will be paid in after the month of sales, it will have been paid in March. 80% of February sales will have been paid in March. But you were told precede. That means before. So it means 80% of February sales will be paid in January. 80% of January sales will have been paid in December of the previous year. So that is the meaning of this clause. So you will need to calculate the payment for sales to calculate the payment for purchases, it relies on sales. That means it is on the sales that your purchases will be calculated. Now, what are the sales made? We want to calculate purchases. Now, let's have working number 2. Working 2. We want to calculate payment to suppliers in respect of purchase. So, you have October, you have September, you have August, you have July, you have June, you have May. Let me recall this is amount is in 1,000 CDs. October 1,000. That means 1 million CDs. September 600. That is 600,000 CDs. August 800,000 CDs. Then July 1 million CDs. Then June, that is 800,000 CDs. May 600,000 CDs. Then we also have for the month of April, that is 800,000 CDs. Then March, and that is 1.4 million CDs. Then February, that is 1.2 million CDs. Then January, that is 1 million CDs. These are the sales made in each of the months. Of these sales, Purchases is 80%. That is note B. Purchases amount to 80% of sales. Of the sales made, purchase amounts to 80%. Therefore, purchases will be purchases, that is 80%. 80% of 1 million, that will be 800,000. 80% of 1.2 million, that gives us 960,000. 80% of 1.4 million, that is 1120. 80% of 800, that is 640. 80% of 600, that is 480. 80% of 800, that is 640. 80% of 1000, that is 800. 80% of 800, that is 640. 80% of this, that is 480. 80% of this, that is 800. These are the purchases made in each of the months. Then, when will the payments in respect of these purchases be made? Payments. Now, back to note B. In note B, you were told that purchases amounts to 80% of sales, which have been calculated, and are paid for in the month preceding the sales. The month preceding the month of sales is when the payment for purchase will be made. Now, the amount recorded against each of the months is the 80% of sales made for that very month. Preceding month, preceding mean before, precede, before. So it means of the purchases that were made in January would have been paid for in December of the previous year. The purchase in February will be paid in January. The purchase in March will be paid in February. That is preceding month. That of April will be paid in March, 640. That of May will be paid in April, 480. That of June will be paid in May, 640. That of July will be paid in June, that is 800. That of August will be paid in July, 640. That of September will be paid in August, 480. That of October will be paid in September, that is 800. So these are the amount paid for purchase in each of the months. So this sum will now be included in our cash budget. Payments to suppliers. Payments to suppliers, that is working number 2. So in the month of April, we have 480. 480. May, 640. June, 800. July, 640. August, 480. September, 800. Now, we've done with payment to suppliers in note B. Now back to the note C. In note C, you have wages and salaries are estimated to be payable as follows. The amount paid in the month of April is 90,000, in May 80,000, June 100,000, July 100,000, August 90,000, and September 90,000. These are the amount paid in respect of wages and salaries. And that will be included in the cash budget in the very month the payments were made. So we have wages and salaries. So in the month of April, we have 90,000. Then May, 80,000. Then after May, we have June, 100,000. Then after June, we have July, 100,000. After July, we have August, 90,000. After August, we have September, 90,000. These are the amounts paid in respect of wages and salaries for each of the months. The firm took a loan of 1.2 million Ghana cedis in January with interest at 10% per annum. Interest is to be paid quarterly in January, April, and so on. So now, if you want to calculate the interest on loans, the loan amounted to 1.2 million. Therefore, interest on loans will be, let me have that as working number 3. Working 3, we have interest on loans. The annual interest, and that will be 10% of 1.2 million. And that will be equals to 10% of 1.2 million, that will be 120,000. 120,000 Ghana cedis. Now, you were told that this interest is payable quarterly. Interest is to be paid quarterly. So what will now be the quarterly interest? Remember, you have 4 quarters in a year. So quarterly interest, that will be 120,000 Ghana cedis divided by 4, since there are 4 quarters in a year. And that will be equals to 30,000 Ghana cedis. So we have Ghana cedis, 30,000. So the quarterly interest will be 30,000. Now, let's include that in the cash budget. But remember, the period of payment of the interest starts from January. The next one will be paid in April. So, if you have, January is not part of our budget period. So, if January is excluded from our budget period, then you have interest on loans. Working number 3. The first interest is to be paid in January, and which is outside our budget period. The next one, which is 30,000, will be paid in April. January, February, March. That is 3 months. A quarter is a period of 3 months. So March, then we now have April. Then April, May, June, that will be paid in July. So we have the next quarterly interest will be paid in July, which is 30,000. Then July, August, September. The next one will be paid in October, which is outside our budget period. So the only one that forms part of our budgeted period is the loan interest for the month of April and July of the year. Then the next note. Now let's go through the note E. The firm is to make payment of tax of 50,000 in July. A tax of 50,000 will be paid in the month of July. So we have tax. That is July, June, July, 50,000. So you can now sum up, since we are done with the note E. The next note is note F. The firm has a cash balance of 200,000 on 1st of April. That is the cash balance. So we cannot sum up the payments. So in the month of April, total payments. Let's have that as B. So 480 plus 90 plus 30, that is totaled 600. In the month of May, 640 plus 80, that is totaled 720. Then in the month of June, we have 800 plus 100, that is 900. In the month of July, 640 plus 100 plus 30 plus 50, that is totaled 820. Then in the month of August, we have 480 plus 90, and that is totaled 570. In the month of September, 800 plus 90, that is 890. These are the total payments for each of the months. Then, after the payments, the next item is net cash flows. Net cash flows. Our net cash flows, which it will be total receipts. Our total receipts is A minus total payments, which is B. A minus B, 1,240 minus 600, then you have 640. Then 880 minus 720, that gives us 160. Then 680 minus 900, that gives us minus 220. Then 800 minus 820, that is minus 20. 920 minus 570, that gives us 350. Then 800 minus 890, that is minus 90. These are the net cash flows. After the net cash flows, the next item to consider is the opening balance, and that is given in note F. The firm has a cash balance of 200,000 Ghana cedis on 1st of April. So the firm has 200,000 in April. That 200,000 will be the opening balance. Then we have opening cash balance. In the month of April, that amounted to 200. If you now add the opening cash balance to the net cash flows, then you will arrive at the closing cash balance. Closing cash balance. 640 plus 200, that is 840. The closing balance in January becomes the opening balance in February. The closing balance in April becomes the closing balance in April becomes the opening balance in May. So we have 840. If you add the 840 to 160, that is totaled 1,000. That becomes the opening balance in the month of June. Minus 1, this is minus 220. Minus 220 plus 1,000. That gives us 780. The 780 becomes the opening balance in the month of July. Minus 20 plus 780, that will be plus 760. Then the 760 becomes the opening balance here. 760, 350 plus 760. That gives us 1,110. And that 1,110 becomes the opening balance here. Minus 90 plus 1,110, that gives us 1,020. That is the end of the solution to the problem. Please drop the love emoji, like the video, and also share it with others. Thanks for watching ZICA.